Ladies and gentlemen, this is the picture that says it all for the year 2008. In case anybody missed it, equities have been in a major bear market in the US and abroad, and we are not out of it yet. In spite of all the negative though, we are very satisfied with our analytical tools that have consistently given us very clear status of the markets, allowed us to take the right steps at the right time, and eventually come out with very good profits. In the following charts, we'll discuss the various markets we monitor, and as we do that, please keep an eye on how our signals kept us on a very steady and clear direction through all the very emotional times we had during the year. This performance comparison chart for all three major indices quantifies the drop in the US equities. The Dow closed the year at a bit more than 35% loss for the year. The S&P 500 and the Nasdaq closed about 40% down. The relatively good news is that the short-term resistance has been broken in December, and things may now improve a bit. But as we said earlier, we are still far from a bullish picture. How did we do? Well, these were the long-term indicators that drove our investing posture. In particular, this arrow shows our bearish alert in late 2007, which caused us to close all long positions back then and look mostly at short-term bearish trades ever since. The daily charts gave us multiple signals pinpointing the continuation pattern points, which could also have been used as possible new entries. We had equally clear triggers in the Nasdaq environment, which we followed by means of the Qs, the QQQQ ETF. In this case, we are now enjoying the positive counter-trend started in December with short-term long positions. We are quite happy about the performance of our systems, and we invite you to stay with us in 2009 to take advantage of these advanced tools. Subscribe to our site, share it with your friends and colleagues, and please send us comments and requests on the format of these reports. Sectors performance ranged from negative 20% for consumer staples to negative 60% for the beleaguered financial, and we'll expand on this in a moment. International stock had very similar performance to the US stocks in 2008, with results ranging from minus 30% for Japan to minus 55% for Hong Kong and Australia. Crude oil has been one of the major stars in the 2008 saga, precipitating from historical highs touched in July to some very low prices now. Our triggers in the crude oil market were equally clear, both in the weekly and the daily scales as shown here. We've been bearish on crude since early July. Gold has been trending downwards also, but on a more convoluted path. Now it seems willing to bounce back, but we'll have to be careful here and refrain from long-term positions for a while longer. The daily chart shows how continued swings in the gold market kept us much more on our toes than other markets, trending more smoothly. Some industries had a very negative time. Here is the example of Pfizer, trending down all year long. But perhaps even more startling is the profile of the financial sector, where the bearish triggers we got starting in mid-07 marked the rather disastrous fall of the sector. Financials too are now in a counter-trend, and we'll see how far that can go. The comparison chart for the year shows how gold closed the year very close to 0% change, compared to the negative 35% of the S&P and the 35% down of the 30-year bonds, and a very bad, greater than 60% loss over the year for crude oil. Crude oil's fall was even worse considering the high in July. The loss from that point is approximately 70% and is quite effectively depicted in the 3-month performance chart. This is it for 2008. Thank you for being with us. Visit us regularly at outpaces.com and share the site and these reports with your friends and colleagues. We'll see you in the markets. Happy New Year and happy trading!